Roger Altman is the founder and co-chairman of Evercore Partners, telling Bloomberg News just a few days ago that the recovery in deal-making could exceed the record $4 trillion mark reached back in 2007. He joins Matt and me here in studio. Good to have you back with us.
Hi, how are you?
I'm okay. Looks like very good, or the deal-making environment actually doing very, very well.
All the conditions that always make, historically speaking, for high levels of M&A are in place right now. You have rising equity values, you have record low interest rates, extraordinary availability of credit, improving business conditions, and all that always spells high levels of executive confidence, CEO confidence. And when you have all those elements in that position, you always have high levels of M&A, and global M&A so far this year is up 50% year over year. That's a lot. That's probably a good index of where it's going to be for the rest of the year, and I would say next year also.
So do you think, you were quoted in today's story on the Bloomberg as saying, M&A cycles tend to last 5 to 7 years. Do you think those conditions as well are going to last 5 to 7 years? Low interest rates, improving business conditions. I mean, are we on an upswing here that you think is going to last? Some
of those conditions will last over an extended period. The recovery we're seeing, for example, in the developed world, at one level is slow, but on the other level probably will be a lengthy one. So improving business conditions are probably going to be with us for some time. Record low interest rates we won't see indefinitely, of course. There's no question that interest rates will begin to rise at some point. I mean, the 10-year Treasury today is 3.16 this morning, and the 20-year average for the 10-year Treasury is in the mid-6s. So there'll be a regression to the mean at some point, and that will change. And it's anyone's guess how long equity prices will rise and so forth. But in general, conditions are very favorable. They're likely to remain, in general, favorable for some time, maybe not quite as perfect as right now. And you also have to add to that what I often call the globalization of M&A. 5 years ago and before, the role of markets like China, India, and Brazil in global M&A was negligible. Today, it's a big role. And when you add that to the usual impacts of an upcycle like this, I think you eventually get a record level of M&A volume, as you referred to at the beginning.
That's interesting, Roger. I think you were part of a Bloomberg link, and I think you talked specifically about China and Asia and saying how much we're seeing in terms of deals. How much of what you do, your business, how much of is it coming from outside the United States? How much of it is coming from either China or Asia specifically? Well, even if it's just talk.
Well, from memory, I think about a quarter of the transactions on which we advised during this past first quarter involved one half or the other half of the deal being non-U.S. That's from memory. I could be slightly off, but I'm about right. So it's playing a big role, this globalization factor,
right,
for all firms, at least major firms in the merger and acquisition advisory business, and Evercore too. And everyone, I think, is in the midst of repositioning themselves towards the big emerging markets, because every year that goes on now, they're going to play, in my view at least, a bigger and bigger role in global M&A. And so you must address those markets. And some people are further along than others in doing so, but it's imperative.
And, we were just during the break talking about your company helped advise AT&T on the T-Mobile purchase, one of the biggest tech deals in recent memory, $39 billion, I think. And we saw, obviously, a huge tech deal today with Microsoft coming out and paying $8.5 billion in cash for Skype. Is this one of the strong sectors, you think, in 2011 for M&A?
Well, I might think of AT&T, T-Mobile as telecom, and differentiate that a bit from tech. But in any event,
think TMT,
In any event, yes, tech is very strong. I would say there are 4 sectors that are dominating global M&A today, and they would be energy, financial institutions, tech, and healthcare. Those are the 4 most active by some margin. So yes, tech is very strong, and I think you're going to see a lot more in tech.
Roger, earlier you talked about how we're kind of in a sweet spot for deal making. What of those, whether it's rates or the business economic environment, what thing could change that would most change the pace of deal making at this point? Is there one particular thing, or?
Well, the only thing that could change in a way that would alter that pace is something that would change negatively, because the pace is powerful now and has a lot of momentum. The biggest possibility, I suppose, is an exogenous shock, which could be for example, a huge oil price spike, and which would play into interest rates, because I think interest rates have remained low for a very long time, and there's a widespread expectation that that will change at some point, although it's likely to change very gradually. I must say, though, I think the equation is pretty solid today for big momentum in global M&A, and that's why I think the financial community, the analysts, and so forth are all expecting a very big year and a very big 2012.
Go ahead.
Well, no, I was just thinking, when I started to see the headlines cross yesterday about Microsoft Skype, and they were talking yesterday about $7 billion. I woke up this morning, it was $8.5 billion in cash, and this is for a company that hasn't made any money, right? For me, it kind of brought me back to the dot-com bubble era when I first started in this job, and I'm just wondering if you think tech has matured to a level that we no longer have to worry about that, or is it still a concern when a company pays billions and billions for a target that doesn't make any money?
Well, I don't think we're seeing any vestiges of bubble-like behavior in tech, at least on the M&A side. And I don't think this transaction, we didn't have any role in it, I should add, reflects any of that. Skype, I'm not an expert on it, but the usage on Skype is skyrocketing. It's a very, very basic service. It has semi-revolutionary characteristics, and I think that it's a very strong strategic step by Microsoft. We'll see how well they eventually do with it, but I don't think Skype is not a small little thing or a fad. Skype is very well established and very widely used.
I want to switch gears, if we may, because you did write an op-ed in Politico, I guess about a week or so ago. We're all watching this deficit and debt crisis kind of unfold in Washington, watching kind of the political wranglings at this point. You suggest in your op-ed, you talk about a smaller budget deal, going kind of for a mini bargain. Talk to us about this and why you think this makes the sense of kind of getting something done here. Well,
this is all in the context of the debate and very, very difficult issue around the debt limit. And just to frame it, a few days ago, Treasury Secretary Geithner said that the United States had to raise the debt limit by August 2nd, or we'd lose our ability to refinance existing debt and to undertake the new borrowings, which we must, given our deficits. And that, of course, requires legislation. And in this environment, with deficits and debt being a big grassroots issue around the country, the prospect of passing a bill to expand the debt limit is a difficult proposition. A recent poll, there was an NBC poll which showed that only 16% of respondents favored doing that, and I saw another poll this morning which said that 62% of the public was against doing it. And so it's a very difficult proposition, and you have a very large number of Republicans in the House. After all, the Republicans took control of the House last November by a big margin, have already come out against an increase in the debt limit. So the question is, how do we actually do this? And it's tied, by definition, to the deficits we're now running, because the reason we have to increase the debt is to finance these deficits as well as refinance maturing debt. Those are the two reasons why you have to increase your borrowing. So there's a direct relationship between deficits on the one hand and raising the debt limit on the other. Now, there's a lot of time by Washington standards between now and August 2nd, and we'll see later whether that's really the deadline or it's not.
Right.
But this is going to be very tough. And therefore, we were talking in that piece about reaching agreement on a preliminary step toward long-term deficit reduction as a way to get the votes to pass this bill. Because on the one hand, solving the entire long-term deficit problem between now and August 2nd would seem too difficult. And on the other hand, the prospect for a so-called clean debt limit bill, which many would like to see, in other words, let's just raise the debt limit and deal with the deficit separately, is not likely either.
Right.
So this is a very tough one. And unfortunately, it looks to me like it's going to go right down to the bitter end. And it's very risky because, you know, people talk a lot about default. You can't play games with default.
No, we can't. We got to leave it there. Roger Altman, thank you so much.
My pleasure.
We're back in a moment.